the Dean of Faculty Economics and Business Universitas Airlangga, Dr. Ahmad Rizky Sridadi. Good morning, the Head of Accounting Department, Mrs. Wiwik Supratiwi. Good morning, Professor of Accounting and Business Information System, University of Melbourne, Australia, Professor Michael Davern. Good morning, Lecturer of Accounting in Universitas Airlangga as a moderator, Dr. Devi Kalanjati. And also good morning to the entire Quiz Lecture 5 participants. So, ladies and gentlemen, welcome aboard and join us on this lecture series 5 2022. My name is Natasha. It's been a great pleasure for me to be the host in this beautiful morning. Now on behalf of the Department of Accounting Universitas Airlangga, I'd like to accept a very warm welcome for all of you. Really appreciate you taking your time of your busy schedule to join us here today. Okay, ladies and gentlemen, before entering our main topic, Horizons of Financial Reporting, I would like to invite the Vice Dean of Faculty Economics and Business Universitas Airlangga to give a welcoming speech in this beautiful morning. Good morning, Dr. Ahmad Rizky Sridadi.
Good morning to Ms. Marinda.
Okay, Dr. Ahmad Rizky Sridadi, stage is yours.
Yes, thank you. Thank you. First of all, allow me to represent Dean of Faculty of Economics and Business, Universitas Airlangga, Prof. Dian Agustia, as Vice Dean of Research, Operating, and Innovation. Allow me to have some remarks. The Honorable Professor Michael Davern, Professor of Accounting and Business Information System from the University of Melbourne, Australia. The Honorable Dr. Devi Kalanjati, one of our lecturers from Accounting Department. The Honorable Head and Secretary, Head of the Study Program, and also the lecturers of Accounting Department, and also guest lecture participant, ladies and gentlemen, colleagues. It is, I think, Assalamualaikum warahmatullahi wabarakatuh. Good morning from Indonesia, Professor Michael Davern and Professor Gilfries. On behalf of Faculty of Economics and Business Universitas Airlangga, it is my honor and also great pleasure to have cooperation with you in the 5th Accounting Department guest lecture series. Ladies and gentlemen, colleagues and friends, today's topic is very catchy, concerning or titled Horizons of Financial Reporting. And in this webinar, Professor Davern will take all of us in depth to discuss issues primarily on dealing with financial reporting. As we know that the current circumstances, and particularly with regard to the financial issues, I think the issues of the strength of the finance and also the perhaps practices of accounting of recent condition, I think we should move into the focus of public attention. So therefore, the process of documenting and communicating financial activities and performance as well over a specific time period is very, very critical, for, in this case, the management decisions. And I think high quality accounting and reporting frameworks are very essential for many objectives, and it might be seen from many perspectives, from as said above, from the perspective of financial health or financial stability, and from any perspective in this accounting perspective seems to have an impact on market dynamics and cyclicality within the financial reporting. I'm therefore delighted to see that Professor Davern from the University of Melbourne, Australia, has agreed to join us today here to share his vision on the horizons of financial reporting. And also I do really hope that we can have many more collaborations with Professor Michael Davern. And we believe that through this guest lecture session, our students, our colleagues, our participants, all of us can get a better understanding of financial reporting, especially in theoretically and practically. Please enjoy today's session and thank you. Wassalamualaikum warahmatullahi wabarakatuh.
Okay, thank you so much, Dr. Rizky. It was a touching welcoming speech. We are all agreed that the topic about financial reporting is very catchy and interesting for us. Okay, once again, thank you, Dr. Rizky. So, ladies and gentlemen, let me introduce you to our moderator, Dr. Devi Kalanjati. And Dr. Devi Kalanjati is one of Airlangga lecturers of accounting. Good morning, Dr. Devi.
Hello, Merinda. Should I call you Merinda or Tasya?
But Merinda.
Both of them. Merinda. Hi, Merinda. Nice to know you.
How are you, Doctor? Okay, maybe Dr. Devi, we would like to invite you on stage as our special moderator. To Dr. Devi, the stage is yours.
Okay, thank you very much, Merinda. First of all, I am actually quite surprised with the number of the audiences that we have now. Michael, David, we have almost 300 audiences, and it comes from our students, of course, from the undergraduate until postgraduate, and our colleagues, not only from Department of Accounting, but also from the other departments. So I am so glad that I am appointed to be a moderator of this great guest lecture in 2022. So I would like to introduce our speaker first before I explain a little bit about the housekeeping of the lecture. I did small research, actually, Michael, related to your past and current work. And I found several interesting contributions that you have made alone or with your team. So started with the article from Mary Ebert in 2018. She gave such challenges that the future of financial reporting could stem from several things. The first one is the greater use of fair value, and of course, a performance evaluation that is designed to reveal the information embedded in changes in fair value. That is the first one. The second one is better information to assess the value of intangible asset. That is also become one of your topic, Michael. And specific information about risk and uncertainty, no doubt. Unbiased information, of course, that's very important on top of everything. and acceptance of a degree of earnings management. And the last one, of course, a financial reporting package that is more convey the information users need. So those are the challenges. And Michael, our speaker today, has contributed important insight through his paper and project that could be used to help us meet those challenges. For example, I can mention thousands actually, but I picked several that I think the most important one. Together with Daniel Sampson, they developed guidelines for effective risk management in retail financial service operation. More specifically, their project developed theory and managerial guidance for facilitating control in balancing risk and return in geographically distributed financial services operations. And that will facilitate a more stable financial service industry and robust economy. Amazing. Years ago, he built a behavior model of effective operational risk management by identifying managerial controllable factors that ensure more consistent and widespread deployment of effective operational risk management practice and attitude. And last year, through his latest report, he gave insight into AASB, Australian Accounting Standard Board. This is actually closely related with my role as a standard setter in Indonesia. He investigated the requirement to disclose unrecognized intangible by Tier 1 reporting entities in Australia. The results suggest that entities are generally not making voluntary disclosure of unrecognized intangibles. The relevant disclosures observed were only in sectors in which intangibles typically play a significant role in the value of the entity. For example, in the pharmaceutical industry. He also contributes to the paper that focus on the use of explanation in big data analytics service. So this is the most interesting paper to me. Yeah, algorithm process large-scale data, we know that, and create efficiency in the decision-making process for organization, but are often incomprehensible to customer and inherently opaque in nature. As a customer, we sometimes very difficult to understand what is that. And using discourse ethics, this paper argues that explanation is important and can facilitate a balanced communication between organization and customers, leading to transparency and trust for customer, as well as customer engagement and reduce reputation risk for organization. Another interesting topic that I think very relevant to us as an accountant related to the lease accounting. Maybe this is also one of the topics that you are going to present, Michael.
Yep, it is.
Yeah, IFRS 16 has revolutionized the way entities account for leases. For the context of Australia, Michael found that implementation of the new standard by preparers was both costly and challenging. However, this is I like it. When the research team asked Australian professional investor whether they saw the expected benefit, their answer were a qualified yes. Investors are generally pleased with the enhanced transparency and comparability introduced by the new standard. And of course, his current project that is still active is financial reporting, insight, and future horizon. I'm sure there is also much valuable insight revealed through this project into the context of Australia and beyond. And that is the one he will share and discuss with us today. And we don't have a reason not to sit and participate in this lecture to know how the future of our products should be, to avoid lagging and disappearance of our existence.
Yeah.
So ladies and gentlemen, without further delay, please welcome Professor Michael Davern. Thank you
Selamat
very
pagi.
much.
Selamat pagi. Terima kasih. Thank you very much for the opportunity to present today and for the fantastic introduction there. You've covered a lot of ground, and one of the things that you might gather from both my titles being a Professor of Accounting and Business Information Systems and the diversity of topics you mentioned, my colleagues politely describe my research as eclectic, as in very diverse, and it's driven by a passion of trying to understand how people make decisions and things that I find inherently interesting in the way that we go. So it does cross a lot of boundaries, risk management, a lot in analytics and data analytics side of things. I actually have an honorary appointment over in our engineering school where I supervise PhD students in the analytics space. If you want another lecture on that, I can do that for you as well. What I wanted to share today was really a program of research rather than a single study, and I'm going to be fairly methodologically light given the audience that we've got as students, so I'm not going to get heavily into econometrics of parts of what we're doing or the research methods, but look at the insights and how we built those insights over time in a series of projects that are really what we call industry engaged research. So this is research that has been supported by industry partners in what we're doing and collaborations with various industry partners over the last several years. At the end of the slide deck, there's a set of references for all the papers that relate to this work, and a lot of those are publicly available industry reports published by the likes of CPA Australia. So please feel free to drop questions in the chat, and I'll try and keep my eye on those as well, but otherwise we'll catch up in Q&A at the end. So let me just share my screen and we will go on. So I just want to highlight the work that I'm sharing today is actually a collaboration with a large number of people over the last several years. The most prolific of my common collaborators here are Dean Hanlon, who's at Monash University, although soon to move to a professorship at RMIT University in Melbourne, and Nicole Giles, who was at the University of Melbourne with me and has returned to a role now as a Senior Technical Director at the Australian Accounting Standards Board. Just with that in mind, the opinions that I'm expressing today are my opinions. Don't take those as institutional opinions of the AASB, my co-authors, or CPA Australia, who I have to acknowledge has been a major funder of a lot of the projects we've been doing as part of this in the collaboration. And so some of what I'm presenting here is things we've been presenting at various forums. Some of this has been presented to the Accounting Standards Advisory Forum of the National Accounting Standards Board, the AASB's Annual Research Forum and CPA Australia Congress. So hopefully we'll get this to a level that everybody can find something interesting and takeaways from where we're going. So what are the challenges in financial reporting, and how did we sort of get started into this process? So this program of research, which is now culminating in the current Horizons project that we're working on, began with CPA Australia commissioning us to do some research. And this was prompted by a book by some well-known scholars, Baruch Lev at NYU, where I actually was on the faculty for a while, and Gu, that had the pejorative title of The End of Accounting. And we've seen over the years quite a number of calls saying that financial reporting is not as relevant as what it was 50 years ago, et cetera, et cetera. People in finance, when I talk to them, would say it's all about cash flows. What do I need these accounting numbers for? And so we've got a lot of criticism of the falling relevance, purported falling relevance of financial reporting. There is some evidence of a decline in relevance in the US market. As you'll see, there's not so much in the Australian market. It's held up well, and there's some differences, institutional structures as to why that might occur. But fundamentally, when we're looking at reporting, we would expect a decline in relevance of financial reporting over the last 50 years, because the market for information about a company has exploded. We now can just click online, get lots of market information at the click of a button, whereas 50 years ago, 30 years ago, Prior to starting my PhD, there was no web, right? So there was no ability to click and get that information quickly and easily. And so the financial statements obviously were highly relevant because that was the source of information that you had that you could access in a lot of cases, whereas not everybody had a Bloomberg terminal where they get up to the second news calls of what's going on. Together with this question of relevance, we've seen calls for expanding the scope of external reporting, and that's in a number of different dimensions. We've seen initiatives like GRI, the Integrated Reporting Initiative, calls to expand to sustainability reporting and setting up of sustainability reporting standards boards in various jurisdictions. As Devi mentioned, there's the intangibles that have become increasingly a point of concern. A lot of looking at risk and forward-looking information as we try to become more and more relevant. And something I know David will have some views on is the issue of service performance reporting in not-for-profits, which is a really interesting and challenging thing that I think brings out a lot of interesting questions for accounting when we look at things that are much harder to quantify and measure. And I've got some unique perspectives on that maybe David and I need to talk about, because I spent the last 4 years on the board of a large not-for-profit, and the financial reporting was interesting, shall we say. The sort of response over time progressively is we're trying to always improve our standards. And so the international financial reporting standards that most jurisdictions are under in some form are being rolled out to ensure we're maintaining faithful representation, but also trying to enhance that relevance. And the two ones that we've got heavily involved in that sort of fed into this program of research was looking at IFRS 15, the revenues from contracts with customers, and IFRS 16 leases. And we did some work starting initially with IFRS 15, where we actually were surveying preparers as they were in the middle of rolling out that standard within Australia, and got some really interesting results about how much they found difficulties in implementing that standard. And we've then fed that over into the leases project, which I'll talk a little bit more about today. I just want to highlight one of the interesting things that came out of that project on IFRS 15 and talking to a number of preparers in this space. We think of compliance with accounting standards sometimes as very much a black and white sort of thing. Yes, there's judgment involved by the auditors and others in looking at that compliance. Some large corporations we spoke to in Australia had some very interesting perspectives on compliance because they were struggling to comply with IFRS 15 because they didn't have a register of all their different contracts, sales contracts in their organization because they were very large. Surprising that you don't have access to that information, but you'll see this is a consistent problem with data. And so their response was, we're not going to be able to comply completely in the time that we've been given, even though the time to comply was extended. But their view of compliance was not an absolute compliance, it was relative. We don't have to comply. As long as we comply at least as much as everybody else in our industry, then the regulator can't ping us. Because the regulator can't go at us is everybody is failing because obviously they're trying to ask for too much for us, which is a very different view of compliance with an accounting standard. That's a preparer's view. I'd love to see the discussion of that with the auditor because I expect there'll be some tension in that. But that gives you some idea of the negotiation around these regulations and the reporting that happens in this process. And we're trying to unpack some of that to make sure that what we're doing is useful and taking together views of preparers, investors and auditors in the sort of work that we're doing. So the program of research that we sort of had here can be broken into 4 parts. It started with this Decision Usefulness of Financial Reporting project commissioned by CPA Australia with us. And I'll start off with that. We then looked at the preparer perspectives on the implementation of the new standards, 15 and 16. And then with 16, we also did investor perspectives. So we went and spoke to investors to get their perspective on how they were dealing with the new standard. And that's ultimately led us then to this new project, the Horizons of Financial Reporting, and this concept we've developed called the reporting pyramid, and trying to understand how we might move through that pyramid, trying to balance the trade-offs between being relevant but securing that faithful representation or reliability, which is so challenging in practice. So what did we look at in this decision usefulness project? We had a couple of research questions. Firstly, we wanted to deal with the issue that people were saying that annual financial reports are not relevant. We want to understand, are they still relevant to equity investors? And has that changed in relevance across time? And what other types of information were those investors making use of it when they weren't using financial reports? What did they complement that with or substitute that with as they were looking at? We had a dual approach to the research methodology of how we tried to gather data about this. So in true and time-tested way that a lot of financial accounting research is done, we ran some econometric models looking at the relationship between stock prices and the release of the annual report. Can you see an association between the information in the annual report, like an earnings number, and what's going on in the valuation per the share price? And we did that over a period from 1992 to 2015 with 29,000, nearly 30,000 firm year observations that went into that data set. That gives us sort of the what is happening picture. What we also wanted to do is understand the why picture of why and how that is happening. So we then went out and did a series of interviews with investors, regulators, and auditors. And what we're trying to understand there is trying to understand what decision making is done with the financial statements and how the financial statements are used and their perspectives on that use. We had over 100 pages of interview text that was then generated, 70,000 words nearly, that we had to then comb through and make sense of to try and extract some themes that sort of fed into the data. And so that's the sort of data we were gathering and analyzing to try and understand this. And some of the just with the interview data, some of that was hand coded, as in we went through and made sense of it ourselves. Some of it we also ran through some text analytics tools to make sense of it. In discussions with a former chair of the Australian Accounting Standards Board, her first reaction to our findings was, you seem like you're very positive in the way that the investors seem to be talking about the financial statements as useful. That's stronger than what I believed. Are you cherry picking the information you're reporting? And so we ran a text analytics on the interview transcripts and found that overall they were actually quite positively disposed to when they talked about the financial statements rather than negatively disposed. So their sentiment about the financial statements was in the positive. They could see the value of the financial statements, and you'll see there's a richer way of thinking about that the econometric models don't quite pick up in the same sense. So let's look at those archival or econometric results, and you can see what we're essentially plotting here is a regression equations results across time of the relationship between market value on net income, earnings before interest and taxes, earnings before interest, taxes, depreciation, and amortization over that time period. And so the R-squared essentially gives you, if you remember your stats, this is giving you how much of the variance in the market value is explained statistically by the variance in each of those three numbers. And we see it hovers around that sort of 50% mark. A couple of things I think are really interesting here. One, that's quite a substantial impact, and contrary to some of the sort of results that we're seeing in the US, it's a fairly stable within a range, so it doesn't look like it's declining at all. So our first question is, this looks great. Looks like we're still relevant. Why are other jurisdictions like the US seeing different data? And part of that is we have different reporting regimes in Australia. The US has a much stronger quarterly reporting regime. And that quarterly reporting regime, we think, we haven't been able to establish this yet, think maybe taking away from some of the information value that's in the annual report, because the quarterly reports have to map to that annual report. So there's an earlier release of information. So it's not about the relevance of financial reporting. It's just the way in which quarterly reporting is treated differently in Australia versus the US, we think is a driver here, because it wasn't driven by things that we thought might be going on. Because one of the things that people thought was, well, Australia has a very heavily driven economy by mining companies and industrial things compared to a lot of the US economy, which is more a knowledge economy where intangibles might come into play. And so with that in mind, we start to then look a little further into what was going on in our results. So let's look at some of the interview data to try and understand then what is driving this relevance of this information, so we can try and unpack that. And what we start to see is that the financial statements, when we talk to investors, become very much a starting point. They give them some confidence. In essence, what we were hearing was, this is the one reported number that I can trust. So this is my starting point as an input to my valuation models. And so everything that I do in trying to project future cash flows, predict future earnings, is coming from the starting point of those audited financial statements. And while they're looking, as they Investor 6 says, we look at a range of metrics, but we derive those from the historical financial data that's in that annual report. There is some communication of non-GAAP information, things that are not a regulated number, and that's often used in a very industry-specific sort of way. And there were industry-specific things. So if you're in the airline industry, you can start to see reports about loads on planes and things that might be a metric that you look there. In telecom, there's a measure called revenue per user called ARPU, which is a metrics they use. So some of those will be there that are industry-specific, that complement the audited financial statements. But the problem that was noted there was, it's not always clear how some of these numbers are constructed, and they're not an audited number. So anything that's not an audited number, they bring into question. And so this was very much sort of saying, okay, it's playing a role. It's not a role that's determining the value of the firm. It's a role that is an input to determining value. It's a role that gives confidence. And our final interview question was always, would you ever invest in a company without audited financial statements? Right? And of course, the response always was, oh, absolutely not. And then they think about it and say, oh, yes, but only if. And the only if was when it was spun off from something that they'd already had investments in and knew, if they knew the management team very well. In other words, if they had direct access through their existing investment portfolio and contacts to private information that could validate what was being reported and what was being said, which the typical investor will not have. And so these investors that we were interviewing were, they were things like chief investment officer of a large superannuation pension fund in Australia, that sort of level of person we were looking at, as well as trader analysts and the like. And so what we're seeing here is, yes, the financial reporting is relevant. Remember our graph, 50% roughly is what we're looking at. This is pretty good. We're telling a lot of the story, but the story is even bigger than that when you consider the role. It's the starting point. They can't start their valuation models if they don't have this as an input, which also meant that they were really concerned about making sure they could trust that number. And so there was some pushback around how much judgment was going into that number and how much scope for interpretation might be hidden behind that number. So it was really interesting in the area you mentioned, Devi, fair values. A lot of our investors did not particularly like fair values, right? And part of the reason for that was that by the time you see a fair value in a financial statement, it's out of date. And if it's got a liquid market, so it's a level 1 input to the fair value, well, the investor can look that up directly anyhow. They just need to know how much the exposure is to that particular asset. If you're looking at something with level 3 inputs, well, then it's a judgment, and there's so much fuzziness to what's going on. Now in Australia, what we see happening there is disclosures also to help us in evaluating fair number of the input ranges that went into a fair value calculation. And that's a great example of where a disclosure has been abused, because some companies in Australia are really taking advantage of that. If you look up the consumer electronics retailer Harvey Norman, their input ranges for their fair value numbers are so wide as to be meaningless. Like, we value properties based on a lease rate that might range from $200 per square meter to over $1,000 per square meter. That's such a broad range. I can't do anything with that input number. And that's what the investors were telling us, is where there was any judgments, they were trying to roll back to a hard number. So they then put in the input to their own valuation models as driving it. So this is a much more nuanced view of how they're making the valuation judgments that they're doing, that the numbers are an input to that, and it's not necessarily in a linear fashion. And this is one of the things I think the econometric models miss, because they're essentially a linear regression. You can tweak it, but it's essentially a linear regression. And the relationship may not be linear because of the way it's being used as an input. We actually saw some investors saying, yeah, this is more like a bar, this piece of information. And so, you know, if they're above the bar, they're in the set. If they're not above the bar, they're not in the set, and then we will move forward. This was particularly around things like ESG, environment, sustainability, and governance disclosures that were being made. So, as I said, one of the questions about why our numbers might be different was around the issue of intangibles, because the Australian economy being more, you know, mining-driven type economy, retail's big here, those sorts of things, versus the US, which has a lot more knowledge-based companies, software companies, telcos, those sorts of things, where the technology and other intangibles may not be there, pharmaceuticals. But if you have a look at what we saw here in terms of various industries, you'll note that we're actually not seeing a decline in the R-squared value. So the explanatory power is not dropping off. If anything, if you take telecommunications and information technology over on the right-hand side of the chart, the blue line is going up. So since 2000, they've actually been more relevant, the annual report, than less relevant at a time when the intangibles are going up. So that sort of puts paid to it's all about intangibles is driving the value. And that kind of makes sense because it doesn't change the role of the numbers in the financial statements as an input to the valuation model. The investor, their IP, their intellectual property is being able to work out how to go from that hard base number to a valuation, and that takes into consideration what those intangibles are, as long as they've got enough disclosures about that, which is something we'll come to. So what are the sort of the implications that we have here? We know now that, yes, we are relevant, right? This was a good news story for us, even though some of the US data is showing something different. I think that's just a jurisdictional difference because of the quarterly reporting. There's a real confirmatory role. It's a trusted number. This is the input to their valuation models, and it's the starting point. It's the one number that they actually trust. Anything else management says, they take with a grain of salt. Right, so they get really nervous and uncomfortable about anything management is saying. Yeah, we've got to question that, but the reported numbers is the starting point. We also see, though, that the financial reporting, statutory financial reporting, is necessary but not sufficient. So in that sense, all the other reporting things we do are complements to that. And while we saw non-GAAP information, non-GAAP financial information as being relevant for investor decision making, we get a bit nervous about starting to regulate that because we want to recognize its role as a complement rather than as a substitute for the sort of reporting that we're seeing and the way the reported information is used here. So we now know, okay, we're doing a pretty good job, but what really matters is we are doing okay on relevance, but what we are winning the game for is reliability. And so this is the sort of start of the take-home message that fed all the way through to our Horizons project, is that in the information marketplace that we are participating in as accountants engaged in financial reporting, that information marketplace has got hyper competitive as there are so many different influence and information sources. We are still a relevant source, but our source of competitive advantage in that marketplace isn't about relevance, it's about our reliability, our trustworthiness, the faithful representation. We are giving the one number that investors trust that they then use into their valuation models. And it goes back to this fundamental idea in the conceptual framework that as financial reporting is not about giving a valuation to a firm, it's about giving information to investors so that they can value a firm. And I think sometimes we lose sight of that. So then it asks, well, how do we increase the relevance? And but also want to maintain the faithful representation or reliability. And one way we can start to think about this is looking at the way different standards have rolled out. And there's a lot of work in accounting research looking at the impact of new standards. We took a slightly different approach. Rather than seeing what the ex post impact was in terms of, did this lead to a share price reaction when people transitioned to this that suggests that they were getting new information, we actually went and said, let's understand what the other side of that equation is in terms of the preparers going through the process of implementing the new standard and what we can learn from that, and then how qualitatively the investors are responding to that. So what are investors saying about this new information? And so we did this with revenue, and then we refined our approach and did it further with some funding support from CPA Australia, looking at IFRS 16 leases. And this is a long-standing debate. My office is near where a colleague who has since now retired, we had for a while on staff here, Kevin Stevenson, who was former chair of the Australian Accounting Standards Board. And he will say he's been arguing for this leases change since the 1970s when he was starting his career back at the original Australian Accounting Research Foundation. There's a long-standing debate about this way of dealing with leases and how much we capitalize versus write off. And so we can see the debate here very clearly. Warren McGregor, former International Accounting Standards Board member, when we spoke to him, there's a demonstrable failure of the existing model to reflect the economic effect of leasing transactions on the financial statements of lessees. So we've got to do something, is what that's saying. When we talked to preparers and others, though, we were getting lines like, I think the threshold for changing a standard should be very high because period on period comparability is extremely important. I want to just highlight that, comparability. So one of the things that we get in the information that we're reporting that's there in the conceptual frame is this idea of comparability that allows us to make rational resource allocation decisions because we are on some level able to compare different companies. And so when you start to make a change, you lose the ability to make that historical comparison. The question is that just a transition cost or is that an ongoing challenge? And the challenge then, if we are going to make a change here, is how do we develop a workable model that convinces the relative constituents? Because, you know, standard setting is incredibly political process with various stakeholders strongly lobbying in different ways. And that certainly happens because it's a regulatory thing, but it also happens even more tellingly if you ever have the opportunity to see, as I've done discussions at the International Accounting Standards Board, it was very telling to see when we presented some work to them related to the earlier project, how the party lines that various individuals on that board could almost be predicted a priori, as in before we presented, I reckon this guy's going to say that, this guy's going to say that, and reflected the sort of stakeholder representations that they were having in the way that they were dealing with that. So there's a lot of politics that goes on here. So as I said, we looked at both preparers and investors. With the preparers, we did a survey and we're trying to understand what made it really hard to implement AASB 16, which is the Australian version of IFRS 16. We want to understand this to inform the post-implementation reviews, to understand the implementation process, and also to provide some peer benchmarking about how firms are going. So we ended up with a survey of 140 CPA, CA qualified professionals right in the middle of that implementation stage. Then after that, we spoke to investors, looking at the cost, benefits, and challenges in interpreting the financial statements that came from that, so we can understand how we might make better disclosure choices to inform those investors. And this was right at the time of the first release of that sort of information was coming out into the marketplace. So what do we learn from some of this information that we're looking at? Firstly, we learn firms didn't have an enterprise-wide register of lease contracts. Wow, that's surprising and disappointing, right? So there was no data there. Now, that raises a really interesting question for me because there were disclosure requirements that were involved. And how do you meet those disclosure requirements if you don't have if you don't have access to the data. And so the data needed to be able to do full recognition and measurement isn't vastly different from the data you needed to make the necessary disclosures under the former standard, but they clearly didn't have the data, and they didn't have the data at the same level. So we learned from that recognition and measurement actually gets a lot more attention from management in reporting and auditors in terms of assuring that the data is there and valid. And so the fact that they just can't tell you how many lease contracts they had was absolutely scary. And you can see that in just the challenge of identifying leases is being a really big part on what was going on. And over 30% of the respondents in the survey were highly reliant on applying some of the exemptions that were existing under the standard for low asset values and short-term leases. So even identifying that we've got a lease, that's a big challenge going on. And where was all the effort? It was in data gathering and setting up technologies to be able to get the data, to be able to then report on this information. And what I want to highlight here is, yes, that wasn't just a transitional thing, that was an ongoing challenge that we were seeing there. And so that's a really crucial issue to be concerned about. As we'll see, data and systems that are underlying this. And so what that actually then shows us is that despite having gone through 15 and seen the data and systems problems that we saw there, which had been given extensions, they were still seeing the same problem. But preparers could see, even though they're sort of biased against having to make change, they could see it would enhance comparability, improve transparency. They still were thinking that they'd be reporting some non-GAAP things, so it's not going to replace the other information they're reporting. No surprise there. They didn't have a view strongly on the faithful representation of assets and liabilities, and I think because faithful representation is such a vague concept that they weren't sure how to evaluate that. What I found particularly interesting here was, and this is something I think standard setters need to pay a lot more attention to, is the real economic effects on the business. So you can see there, top of the list, what's going to happen in terms of effects. A lot of them were saying it's going to lead to better management of leases. So having that information now being required to be externally reported drives you to collect the data, so you actually end up better management leases. And I think this is one of the sort of real effects arguments that standard setters need to pay a lot more attention to. And those charged in organizations at implementing standards need to understand the business case isn't just a compliance-driven business case. You're actually going to get better data and better management of it. And we saw this when we were looking at the revenue standard 15 as well. And in discussions with corporates, I was very disappointed that a lot of them were just trying to comply. And I said, doesn't anybody see that this is essentially giving you a compliance justification for all those data and systems projects that you knew would be valuable, but that you couldn't really make a strong enough business case for because they were so big and amorphous? Here's the compliance argument. And we see in the case of leases, it's going to lead to better management of leases, as well as changing and renegotiating some of those contracts as we go around. When we talk to investors, their views varied considerably. Some said, no, doesn't matter at all. Right? We're already taking into consideration what was not on book. We're not idiots. We know there's things that are not on book. So why does it matter? Interestingly, when it goes on book, they then react to it. Others were saying it's a significant impact. And the impact here is certainly much more industry and firm specific. If you're a supermarket chain with a lot of leased premises, that could have a really big impact because this brings in things, and when you've got cascading chains of leases that may make it less of an operating lease and now something that you're going to have to capitalize. The other sector that was really impacted by this is the aviation sector with airplanes. So I think one of the interesting quotes we got from an investor is, so I think there's a strong appreciation that in an economic sense, things aren't changing about these businesses, but the way that we analyze these businesses is significantly impacted by the standard. So that means we've got to develop new heuristics, new ways of interpreting the numbers. And so this is a key message we're starting to see. The financial reports are information is our input to our valuation models. You change your standard to improve things. I've now got to change my valuation models to adjust for the new reporting regime, because that number that you're reporting before doesn't mean what it did before. So the way it comes into my valuation model as an investor is different. And there's a key question we don't know the real answer for here, which is how long does it take an investor to learn what is the new approach to doing this? How long do they change their valuation model to optimize it for that new information, as opposed to sort of still having more error because they now got a number that means something different to what it did before? And that's a really interesting and challenging question we'll see come back up. So in terms of this recognition versus disclosure debate, which is where I sort of want to take this argument, is, some are arguing it's going to give us better transparency and comparability, so help in understanding the cost of capital if they're doing the right thing. Particularly for those companies where they were owning a lot of their properties versus leasing them, it now makes those much easier to comparable. It's a net positive. Some would actually say it's helped remove all was hidden behind the skullduggery of trying to do purchase and sale and leaseback transactions that could sort of hide things in what was going on. Others were of the view, no difference. We just needed the information because we're going to take it into our valuation models and go with it. As long as we've got enough stuff somewhere to inform our valuation model, it doesn't matter what you're reporting. And some recognizing the market hasn't yet adjusted. So there's this adjustment period, as I say, learning about what's going on. And so there was also a view that as we look back in this in 20, 30 years time, it's sort of, why haven't we done this back in the 1970s when people was first initially jumping up and down this? And for the students in the audience, this leasing issue has been a long-standing debate because, back in the late 1980s, when I was an undergraduate student, that's when we got the first leasing standard in Australia, and there was a lot of controversy around that. And now we've taken the next step to what some were calling for in the 1970s as the former standard was being developed. The big issue to take away, I think, here is that we are hurting historical comparability. And so there is an investor burden when we make a change to the standards. We can't rely on the historical comparability of the data to be able to see what a trend is. We have to go rework all our heuristics about how we are interpreting that number, all our valuation models. And so that's a really problematic, because most investors are not looking for, they're not day traders. They're looking for long-term value creation. And so they're looking for being able to predict what is sustainable earnings into the future. And so understanding how stable earnings were in the past and what was driving those earnings would be really valuable for them. And now we've taken away historical comparability. It makes it much harder to try and say, what is the trend, and is the trend continuing, when you've got a disjoint, when the change of the information is so dramatic in this regard. And that's really what they're focusing on in what they're doing here. One of the things that we did see going on was some investors saying, well, in the transition, we still get both sorts of information reported. We still get the old information as well as the new standards, because they've got to do it side by side. And so we haven't bothered to update anything yet. We're still just using the old numbers. So there's a cost in that transition for them, which is going to create less efficiency in the marketplace and cause problems. And what I'm really interested in trying to learn is what drives the length of that learning curve before we get comfortable with a new number, because that's the interpretation side of the reported information. And that goes to whenever we're reporting information that is not, really objective and hard, but involves judgment. Yes, we're adding value, but we're also adding complexity and how they interpret that softer or fuzzier number, which is something you'll see come through in the later part of the project. The big part where this did affect was things like earnings before interest and taxes, earnings before interest, taxes, depreciation and amortization, which so many investors were using as proxies for cash flow information when they were looking at things. And now we're completely thrown those numbers out because of what you've done with the adoption of the new leasing standard. And so what then happens here is there's more opportunity in that transition as there's more noise around what's going on for management to spin. We lose in the transition some usefulness of information. And what we need to think about is the difference between that transition stage of the new standard coming out and post-transition. And it's a hard case when we make changes. So we shouldn't be changing standards all the time, because there is a real cost to all players in the marketplace in changing a standard, not just the preparers who are always lobbying against change, but also for the investors who are the ones that reporting is supposed to be servicing, because then they have to revise their valuation models in what's going on. So what are the sort of takeaways we get from this? Data and systems, again, so we saw this with the revenue standard, we see it again with the leasing standard. Organizations just don't have good data. They don't know what's going on. And the switch of something from a disclosure to more recognition and measurement, or more detailed recognition and measurement, means I've got to have the data and systems in place. That's huge. That's good for the organization, because they're going to get a better operational management. They're going to know what leases or revenue contracts they've got. And it's surprising how little they know about that sort of information. And so there's an interesting business case there for keeping to upgrade your data and systems to ensure that you have that information there, and that the mandated reporting of things is actually driving business innovation through improving the operational efficiency of businesses by getting them to have to collect data that they might otherwise not, because they don't realize the economic benefits of it. From a financial reporting perspective, it really highlights this recognition versus disclosure distinction. And that's coming from that data problem. So recognition appears to much greater management attention and auditor retention, because when we were just making disclosures, yeah, that looks okay. When we're having to recognize and measure it on the face of the financial statements, then we're really paying a lot more attention to the quality of the data that's going in there. It's not that we were ignoring it when we're just making disclosures. It's a risk-based approach that we have in audit. It's similarly in the way management attention go there. So I trust a number that is fully recognized and measured much more than anything that I'll see in a disclosure. I know it's going to be a more reliable number of, and higher quality level of reporting than what I'll see in a disclosure. And that highlights that when I'm disclosing information rather than recognizing, I have to make some adjustments for the lower quality of information. So this quality of information issue, I think, starts to become really crucial, because remember, what we learned from the first project was this whole idea that, yes, we're relevant, but our source of competitive advantage in the marketplace is we're the one number that they can trust, right? We're the input to the valuation models, we're the reliable source, we're the starting point for the valuation process. And so if we are providing low quality disclosures, does that really help as the starting point, when our starting point is because we are trustworthy and reliable? Adding to that, we saw transaction costs, both for preparers and investors. How we regulate some of the non-GAAP numbers like EBIT and EBITDA become really important, and that's something that I know the International Accounting Standards Board is playing with, how that might be presented. I've had a PhD student actually having a look at some of the stuff in that sort of space and seen some interesting issues in how we see things that are captured in other comprehensive income and moving beyond those sorts of things. The good news story here is that standards have real effects. So this is not just arbitrary regulations that a standard setter is putting in place. It's actually has potential to improve the operation and efficiency and effectiveness of the organizations that are impacted by the standards, because it's driving them to get better data and information for decision making. And we saw that with most reporting, they'll have better management of leases. This is a good thing. This is a real benefit for standard setting. We're not just talking about more efficient allocation of capital in the capital markets by better reporting. We're talking about actually making the individual entities themselves much better managed, because they've now got better information to manage, because we've effectively mandated that they get the better data, because they then have to report more. And so that creates some interesting flow-on impacts that I think is a good news story for standard setters, that you actually don't just create red tape that everyone thinks is going to slow down the economy and stifle innovation and everything like that. You're actually creating mechanisms that are driving better information for decision making, which will have flow-on effects beyond that. With all that sort of as the backdrop, that led to where we're now in this Horizons project. And what we're trying to address in this Horizons project is how to respond to calls for expanding the scope of reporting without sacrificing the essential role as a reliable information source. We're the trusted quality information source in the marketplace. We compete based on the fact that we are the most trustworthy disclosure that is out there. That's what the investors are valuing us for. So if we try to expand and become more relevant, we're going to make sure that when doing that, we're enhancing relevance, but not at the cost of the faithful representation or reliability, because that is the key thing that we are contributing. There are a lot of other sources that are relevant, but lack the reliability. And so we won't ever win the relevance debate and battle because we're not fast at reporting, given what we are doing, because we can assure the reliability. That whole assurance process is a strength. The time we take to get to the reporting periods is a strength, because it means the number that comes out is a trusted number. And I think that's a key thing not to lose sight of, that reliability role becomes increasingly important. From a frameworks perspective, where did we go with that? We developed something we call the financial reporting pyramid, which I'll show you in a minute. And what we're trying to understand then is how we look at this recognition and measurement and disclosure debate. And we've done interviews with preparers and investors focusing around several thematic areas so that we can see different themes about what are the challenges in how we might expand what we're reporting on without sacrificing the reliability of what we're doing. And those themes that we've chosen to focus on are, unsurprisingly, intangibles, sustainability, and risks forward-looking information. And they actually tie up together. And just to be clear, when we talk about sustainability, it's much more than climate change. So let's have a look at some of those issues that we see then and how they play out in this financial reporting pyramid. So at the top of the pyramid is our gold standard of recognition and measurement in the financial statements, right? That's what investors are valuing because it's the starting point to their valuation models. The next sort of level down in trustworthiness is the mandated disclosures in the financial statements and notes. Below that, we get voluntary disclosures. Then we get disclosures in other reports, voluntary reporting consistent with some other framework like integrated reporting, etc., and voluntary disclosures via other means. And as we move down that hierarchy, we're getting less formal regulation and less assurance. So the quality, the trustworthiness, faithful representation, reliability of the disclosed information goes down the lower you are in the pyramid. And our question then is, if we're getting expanding scope in financial reporting, we're essentially wanting to push things up to the top of the pyramid into that recognition and measurement space. So what are the things we need to think about in moving from voluntary disclosure to mandated disclosure, from mandated disclosure into full recognition and measurement, as we did with leases? And be clear, we're not trying to reinvent the conceptual framework. We're not going to be looking at debates between should I be using GRI or the integrated reporting framework. What we're trying to understand in particular is this movement into recognition and measurement. What are the challenges and issues and the things that we need to think about in terms of guidance when we make that decision to go there? And what are our investors and preparers telling us about how that might play out? So I said, we know that investors trust the audited numbers. We know that measurement uncertainty is often a reason why we might only disclose something rather than give recognition and full recognition and measurement to it, because we're just so uncomfortable we can't measure it appropriately. It does lead to the ridiculous situation. If we look at something like intangibles, we know a lot of unrecognized intangibles have value. the fact that we don't disclose them essentially says we're putting 0 as the value on them as far as the financial statements are concerned. Yeah, I think that can be overinterpreted, because really what we're doing is we are not, when we're giving someone a book value, saying this is what the company's worth. What we're doing is giving a starting point to a valuation model. So I always have this challenge with students when I first present them book value versus market value. And inevitably one student will say, so which number is right? And, you know, the book value is the thing that's based on all our accounting principles to guarantee and give us assurance about that faithful representation of the underlying economic reality of the business. And the market value, well, that's just a collective opinion of the market participants at a point in time. And it's not even a consensus opinion, because if I'm selling a share at $100 and you're buying at $100 a share, then you're expecting it to go up. I'm expecting it to go down. Otherwise, why would I sell it? So it's not even a consensus opinion. So what do I have? Neither book value or market value are true value numbers. What is the true value of a firm? I don't know, but now I've got 2 inputs to my judgment. One that is principle-based, that is highly trustworthy, and one that's a collective opinion of a marketplace. And using those inputs, then I can make my valuation judgment as an investor. What we have traditionally seen is where we have measurement uncertainty, we disclose things rather than recognize them so that the investors can make their own measurement assumptions. Leases is trying to push that a little bit further because we're going into providing information that actually is more about valuing these things. And we've got discount rates that are being captured in these things, which are projections forward. When we look, though, at the reliability of some of the things that we are reporting, the precision or reliability with which we can report some of those items that we currently report is actually a lot less than things that we are thinking about reporting. And I'll give you some examples in a minute. So while this measurement uncertainty seems to be the deciding factor, there's some things that are a lot harder to measure that are already being reported on than some of the things we're thinking of now incorporating into recognition and measurement stages. And what we're starting to see when we look at the financial statements, we're seeing huge variability in numbers we might say are really hard numbers. They're based on objective observable facts like in historical cost, and soft numbers that involve a computational process with lots of judgment that are involved. So think about cash versus leases, right? There's a lot of things that go into the valuation of a lease. Some of it's formulaic, but some of it is judgment, right? Cash, I know how much cash I've got, right? We can actually audit that quite clearly. But even when you get into some items of revenue are hard and some are soft. As we look at things like variable consideration in revenue, there's allocation processes. We know that recognition changes the quality of the information reported, but how does it play out in this hard versus soft sort of distinction? And I'll elaborate on where we go with that. So then getting into our thematic areas, look at disclosures around intangibles. At the moment, current Australian standards are encouraging voluntary disclosure of unrecognised intangibles. We only recognise externally acquired intangibles. We don't recognise internally generated intangibles, but they're encouraged to make disclosures about some of those unrecognised internally generated intangibles. The AASB has just been released a discussion paper on this, and as part of that, they had us do some research where we tried to find exemplars of firms who were disclosing unrecognised intangibles. And we did a fairly comprehensive search, and we found it really hard to find any examples of disclosures of unrecognised intangibles. We think a lot of this has to do with we don't want to have the fight with auditors about what's being said there. And the closest we would come was in the pharmaceutical industry, and they were more backhanded type disclosures of, we'd like to disclose this, but we're not allowed to disclose this because it's not a recognised intangible. But if we were able to disclose this is what we would say. Which is a bit convoluted way of sort of not being held accountable for that voluntary disclosure. And so they're really nervous clearly about voluntary disclosures, and nobody's embracing it. And I think part of this is also recognizing that the annual report is not a good channel for voluntary disclosures in this way, because you're going to get auditors having a look at it, and that's going to create some friction for you. And voluntary disclosures have other issues where they can just be information signaling rather than substantive, which I'll talk about a little bit later. So the question arises quite fundamentally is why the difference between internally generated and externally generated intangibles? Well, the argument has always historically been we've got arm's length transactions in those externally acquired intangibles that give some objectivity to them. But if we look at a lot of the internally generated intangibles, some of those have arm's length transactions as part of them that we can put in that maybe we make some recognition and disclosure about. So if we're buying some equipment to build some software that is, or do some R&D, the equipment and salaries of the people, those are arm's length transactions. So now it just becomes that capitalization versus expense sort of debate rather than a recognition versus non-recognition type story, and why are we putting them as expenses? And I always think of when we look at assets is assets are just expenses in suspension waiting for us to consume that economic benefit. The other thing is there's always judgment whether we've got externally acquired or internally generated intangibles, because if I externally acquire those, often there's a bought in combination, sometimes with some physical assets that I can point to, some tangible assets. And so how do I allocate the values? That can be really difficult. And so there's judgment involved. And how is that different from the judgment that we're seeing there? And so that raises the question of, if we're going to start to recognize and disclose some of these internally generated intangibles, it requires the investor to get a bit more comfortable with some of these soft numbers, and requires us to make sure we're not killing the reliability that we have in that gold standard of recognition and measurement. And so this idea of thinking about, and hopefully you start to see where we're heading, about maybe we need to report things differentially. And one of the people we've interviewed in this process had a really novel suggestion. He said, I'd like to see 3-column reporting. In column 1, we have the objective hard numbers that everybody agrees in. In column 3, we have all the really fuzzy soft numbers that are very much open debate. And column 2 is somewhere in the middle there. And so it's giving some sense, not just that we're reporting information, but we're reporting about the quality of the information. This is objective, fully assured. This is some subjectivity with assurance. This is highly subjective, but we generally agree with this, but it is a judgment, not an objective number, and how we might think about how that reporting might evolve in time in doing that. We see a similar sort of thing happen when we start to look at the sustainability, risk, and future-looking information. First thing I want to clarify is this is relevant not just to stakeholders who are trying to say, let's make sure we're carbon neutral and those sort of things. It's relevant to investors who want to know where are the firm's assets, where are the firm's suppliers and customers. The example that I'll use here is climate scenario modeling, because it does bring out the future-oriented things, and we're seeing that the Task Force on Climate Change related financial disclosures, TCFD, is actually being adopted as a regulated practice in some jurisdictions. This is future-looking information, so it's inherently uncertain. And it's even more complex than that, because if you think about what the TCFD is implying in its climate risk scenarios that it's asking firms to disclose, there's really at least 3 models that you'll have. You'll have your model of climate change, which, there's debate about whether that should be independently verified or taken, or whether it's firm specific. There's the model that models the impact of that climate change on the firm, thinking about its customers, supply chains, and assets. And there's the model that looks at the response of the firm to that climate change impact and what strategy it does, and whether that strategy is going to change in positive ways or not. But what I want to highlight, financial reporting is already forward-looking. And so while we talk about expanding scope, really we're actually just redefining things and trying to understand things better that always were in scope. Because if I look at the definition of an asset in conceptual framework, it's about future economic benefit. So it's future-oriented. So I don't buy the argument that we shouldn't report on things that aren't future-oriented just because they're future-oriented and therefore uncertain. We're already doing that. The question then is, so what is driving that otherwise? Some of that is the measurement uncertainty can be greater, but in the climate scenario case, we've also got a lot of other uncertainty that we can clearly see about government regulatory actions and those sorts of things that come into play. Do you have a carbon tax? Do you have a carbon price? What I want to highlight though here is going back to that point I raised earlier about the reliability of the information. The uncertainty may be in the valuation, but it's often not in the underlying science or facts of what we're looking at. So if you take something like a biological asset, you know, whether it's farmland, whether it's cattle grazing on farmland, whether it's trees that you're using for carbon sequestration. Talking to scientist colleagues, ecologists, botanists, and those sort of things, you look at the models they have for trying to understand how much carbon, for example, has been sequestered in trees. They have really highly reliable models that capture that they know with 90 to 95% reliability how much carbon has been captured in the trees that may have been planted as part of a carbon sequestration thing. I've not seen any non-historical cost number reported in financial statements that I'd be comfortable to say there's a 90 to 95% certainty attached to that that number. So we're already seeing those sort of things in our financial statements that where we have much less reliability in the numbers that we already disclose. So this is the debate. And then the question becomes, do we report value or do we simply then provide the input of those biological characteristics in a disclosure that can be input to valuation models? We hit problems there, of course, because of the recognition versus disclosure debate that I've talked about. We hit problems too with comparability and consistency because they're going to play out differently in different contexts. And assurance becomes much more complex. How do I assure that the amount of carbon you say is here is there to know what the value of that forest that you planted as part of a carbon sequestration activity? So there's a lot more cross-disciplinary knowledge that's going to come into play, but the accountant has a big role to play in that. So to sort of wrap up, and we've done things in reasonable time here, so I'm quite happy to be on target with that. Moving forward, where we're at in this project, it's still ongoing. The underlying problem of this trade-off between faithful representation and relevance, we're not looking for a solution here, but rather a path to a solution. And that's the reporting pyramid and trying to understand what are some of the factors as we move up and down that reporting pyramid that come into play. And the sort of questions we are seeing there is, well, in this debate between recognition versus disclosure, one of the things that we see coming out is this question about who is in the best place to put a value on that number, all right, on that item. Do preparers and auditors have superior information relative to the users of the financial statements? Because if they don't, then leave the valuation to the users of the financial reports. Give them the inputs to their valuation model. Don't try and put a value on what's going on there. So when I start to look at a lot of the fair values, this fails that test because preparers and auditors don't necessarily have better information about the marketplace for liquid assets. And for the non-liquid assets, that would be the input level 3 inputs, I'm not sure they do either. All right, so maybe we need to change the way we're disclosing that. The caveat to that is we know disclosures in practice aren't as reliable. In the debate between mandated versus voluntary disclosure, we see voluntary disclosure can be problematic. People just don't do it. And you also create this problem of this signaling effect where I'm going to make disclosures about this, like climate change disclosures, to signal that I'm paying attention to it, when we're not in substance paying attention to it. I just want to make everybody think we're paying attention to it, versus an organization that has taken that to core and is making more substantive disclosure. I think the most interesting future direction, though, is in this hard versus soft numbers space. What is the investor learning curve to get comfortable with those softer numbers? How do we distinguish between hard versus soft numbers? How do we report these to investors? I've got a colleague who suggested we should put confidence intervals, if you remember your intro stats classes, around what we disclose in financial reports. And my response to that, having some expertise in behavioral sciences and how people interpret numbers and decision making, is that I'm not sure most investors will be able to intelligently interpret what a confidence interval actually means, because we don't tend to think about statistical distributions naturally. I don't know very many people who say, I think like statistics does naturally. It's a way of thinking, and so that confidence interval is very hard to really interpret into our judgments of value. So we've got a long way to go forward, but I think the take-home message is I would sort of say here is that yes, financial reporting is important, remains important. It isn't going away. Our competitive advantage is in that we are the trusted source of information. So as we expand our scope, we're going to have to get more multidisciplinary, but we're going to need to be careful that we don't do that in a way that kills the reliability of what's going on. And we need to start to think about how we're going to talk about hard versus soft numbers, and in the way that we're reporting on this information, so that we can do that. With that, that's the end of my presentation, and I'm happy to open to questions. Terima kasih.
Okay, thank you very much, Michael. And would you mind to take down your slide, and then I will share all of the questions from our audience, and there are actually quite many.
Cool.
We still have around 20 minutes before closing, and wait a second. Okay, let's go through the questions one by one, and then maybe you may give a brief answer. Okay, so for the first question, in your opinion, when misvaluation can be persistent and why it can happen?
Look, we hope this doesn't happen, and hopefully assurance can be informing that. So let me sort of distinguish here. Misvaluations in reporting shouldn't happen over time. Misvaluations by investors can be because their models are imperfect, and we're predicting the future of where value is going to go, and things will happen. You know, you talk to someone in 2018, none of the valuation models would have taken into consideration that COVID-19 was going to come and how that changed things. Even in looking at things like how marketplaces go. So we've seen over the last 20 years, a lot of fluctuations over time in something like oil prices. And as I said at the start, I've done a lot of work with Petronas many years ago, and they hit some real issues about 10 years ago when the oil price dropped to $50 a barrel, because 60 to 70% of the projects that they were currently engaged in had become NPV negative. All right, so that's because they didn't expect it to go below $50, down to $50 on the oil price, because it'd been up over $100 a barrel. So those sorts of things. So I distinguish between sort of misvaluations, both in terms of reporting misvaluations by investors, and those that are driven by we just don't know the future, and those that are driven by inadequate models or inadequate understanding of what's driving value, and it's getting to this stage of recognize that in accounting and in business, at the end of the day, we make judgments, and sometimes those judgments we're wrong. And what we've got to look at is, you're right in highlighting the persistent part. If we're persistently making mistakes, then we've got a problem. We need to do something about it.
Okay. And the second one, I think they're talking about the disclosures. How about the amount of the disclosures too excessive?
Yeah, so this was a really interesting one when we were doing
that is also possible.
Yeah, it was when we're talking to our in our interviews for the Horizons project, one of the things that kept coming out, and this was interesting, not just from investors but also from those involved in preparing and standard setting circles, was if we're going to put something into the financial report, what are we going to take out of the financial report? And I think this is this tendency that, we can only be more relevant by adding more. And as I said, I think part of that goes to the whole issue of the quality of the information we provide is what we're really competing on, not the relevance and comprehensiveness. And we've got to go away from this mindset that we have to provide all information that might be relevant, because I don't think we can, and nor is that our role. Our role is to provide enough information to be relevant, but provide it in a way that is of high quality.
Yeah, this also become a major concern of the ISB. One of
Yeah.
the project that we are still doing is the disclosure initiative.
Yeah.
Yeah, so basically how to make the disclosure part of the financial statement is more consistent, relevant, but also understandable to our investor.
Yep.
The third question, I actually don't quite understand about the non-monetized asset.
You're
Is that
talking
mean
maybe
the
about
non-monetary
non-financial assets.
Yeah.
Sure. I mean, you can look at what you paid for them. That's the sort of historic cost. Where you go beyond that, I mean, to be honest, I'm not a fair value fan. And the reason I'm not a fair value fan is because, as I said, for those things that have a liquid market, you know, if you make the right disclosures, the investor is going to have just enough information, and they're going to have more up-to-date information because they'll know that beyond balance date. If for those that are not there with a liquid market, there is so much judgment that may go into that number. And we've done some work looking at people making decisions where you just change the nature. And if you look at the standards, it's actually called fair value measurement. I think it should be called fair value estimation. And because you can measure the inputs, you can't measure the fair value, because the fair value is a future transaction that hasn't happened yet. And we did a little experiment with people reading financial statements where we changed and labeled everything either estimation or everything measurement, same valuation method, and the reliability of the number was seen vastly different when you call it measurement versus estimation. So the label of measurement creates this sense that this is a reliable and trustworthy number when it's got so much judgment involved, and that sort of thing really scares me. I'd rather have a trustworthy, reliable number that I can extrapolate from, because in the work we've done with investors, so often they want to unpack to get back to the concrete hard number so that they then put their assumptions, their intellectual property about how they think the valuations and should go forward, and they can test the robustness of that on a whole range of assumptions.
Okay. And next question, talking about the many different needs of our stakeholders and how, from the company's perspective.
Yeah, look, I think this is where we've got to be really careful. And I was really pleased several years ago when the International Accounting Standards Board revised the conceptual framework to focus on investors as the primary stakeholder, because I always think when you try to please multiple stakeholders, it's kind of like one size fits all clothing. It never quite fits anybody very well. And so I think there's other ways of dealing with communicating information to some of those other requirements, and that's beyond, you know, your balance sheet, profit and loss statement, cash flow statement. And we've got to be really careful about how we are servicing those other stakeholders. It's not that they're not important. Absolutely, they're important. And from a holistic sort of perspective that we need to be engaging with those stakeholders. But let's not kill the information that we're giving to investors when we do that.
How about in Australia? We also face the same requirement that more information should be delivered to not only to our investor, but also to the other stakeholders.
Yeah, and the big push is coming on a lot of these sustainability disclosures and where that's going to go. And I know that's very much on the agenda of the standard setter here. The AASB runs an annual research forum, and we're presenting particularly on the sustainability aspects of this project in November on that part. Yeah.
Okay. The next question, asking about the externalities that presented in income statement.
So I'm not exactly sure what you're looking at here, but it's one of the things you've got to recognize when you're looking at an income statement. You can't evaluate without understanding the context, right? So I could give you a profit number. I agree with you. And is this good profit? Well, it depends on multiple things. It depends on what's going on in the balance sheet, the asset base. You know, I used to do this with the Petronas guys. I'd give them Petronas numbers and ExxonMobil numbers and get them to compare even the return on assets. Say, is this good or not? Well, it also depends on the risk that you're exposed to, right? Because Petronas does more exploration than what ExxonMobil was doing, so it's exposed to greater risk, which means it's got greater upside. It's also thinking about those macroeconomic sort of market environment things, because it's easy to make profit in an oil business when the price of oil is over $100 a barrel.
Yeah.
It's very hard to not make a loss when the price of oil is $50 a barrel, right?
Yeah,
That's
yeah,
not
yeah.
something that management can control. So when you look at the income statement, you've got to bring that context. And that's why, as an accountant, you will need to understand macroeconomics, microeconomics, and these other areas, because there are no accounting questions. There are business questions, and you've got to understand the context of what's going on. So when I look at a set of financial statements, they are, to me, the starting point in the way that I look at things. And by understanding how those numbers were generated, I can go back to understand what was the likely underlying economic reality that led to those reported numbers. And then I can connect that with the broader market knowledge about what's happening in the marketplace. And this is where we see the importance of things like segment disclosures to understand where the business is exposed to in terms of markets and supply chains and the structure of its business, to try and predict that persistent future earnings.
Okay. The next one, focusing on the green economy. So maybe you can share us from the perspective of the Australian.
Yeah. So what I can tell you there is a good example of where my views are on green accounting and sustainability more broadly than just the green. So thinking about social sustainability and as well as environmental sustainability. Our Bachelor of Commerce at Melbourne now has a required subject that all first-year students do called Sustainable Commerce. And so I don't think you can get away from that. This is what every boardroom is paying attention to at the moment, because it goes to the future of their business. It will be impacting their supply chains, their assets, their customers, and so we've got to be making sure we're reporting on it in the right way. I think there's some really interesting things happening with TCFD and those climate risk scenario reporting, but I'm also really concerned about how those get interpreted, because there are multiple scenarios possible. There's multiple models, as I indicated. And so it's going to take a long time for investors to make sense. And at the moment, with a lot of voluntary disclosures going on, you're seeing a lot of things that are signaling. I mean, when our large mining companies in Australia are making disclosures saying, we're green and environmentally friendly, I then go, you're a mining company. You're inherently not sustainable. Fundamentally, stop it. But they're recognizing it, and so separating out. This is what a good accountant's got to be able to do: separate out in the reporting the window dressing of making things look like you're dealing with them versus the substantive, what's actually going on in the business. But it's going to be there, and that climate risk is coming through, because we're also seeing from the investor side demand for that, as there's a growing area of ethical investing and investors looking at ESG things. And when we looked at investors, one of the things we saw there was that was a good example of where they would use things not as a metric of how good or bad you are that impacts your value, but if you are below a certain cutoff level, we won't even put you in the consideration set as a potential investment. Once you're above a certain level, then it comes into play how much that is an issue in the evaluation. So if you're not considering these green issues, then a lot of investors will start to progressively cut you out of their consideration set. And it's kind of like what's happened over the last several decades with tobacco companies. Right? Nobody wants to own tobacco companies other than for the immediate cash flow. They're great for generating immediate cash flow, but nobody's buying into tobacco companies saying there's long-term sustainable value here. They're buying for the immediate returns they're getting on their investment, and that changes the valuation approach quite dramatically.
Yeah, so I think the idea of the green economic maybe come from the other stakeholders, but not from the investors. So the investor, the important for them is the profit.
But the investors are and that's where the change is happening. So the investors are starting to demand that, because they're seeing that if you're not paying attention to that, then I've got a time horizon when you're not going to be able to sustain your business, right? Because or either the regulation or the climate change is going to kill what's going on in your supply chains and what's happening with your customer base. Right.
Okay.
I mean, if you're, and I give you a concrete, simple example. Take a discount retailer like a Kmart type store, right? They sell clothes very cheap. Where are a lot of those sourced from? They're sourced from Bangladesh. well, if we get climate change the way it's going to look, we see sea levels rise, a lot of Bangladesh is going to be flooded out, and then you've lost your workforce and your supply chain. Now, what does a Kmart store have to do and think about with respect to a green economy? It may not impact it on its day-to-day basis in what it's doing, but it's the future of its supply chain, which impacts the future of the whole discount business model that it's got.
Okay. The next one, is it good for firm to report forward-looking accounting information in terms of a rival firm? Is it?
I wouldn't be reporting information about how we compare to a rival, because one of the things that behind the scenes is a really important concept to remember in this issue of what we report is there's what we call proprietary costs, right? And this is the idea that anything that I'm reporting as a public company to investors becomes public information. And so some of that information I don't want to report, because in reporting it, it's not that it's bad for me or make us look bad, it's that it'll actually create a risk that a competitor will know what we're doing and then be able to extract some of the value we've got. So I don't want to be too much revealing of that so that competitors can take action. And that is actually the one argument that I see for why we might continue to present information at more aggregated levels, because it's a way of sort of reporting something but not revealing too much proprietary information in doing so. And that creates a challenge. One of the thought experiments we've done is, what will financial reporting look like in 100 years' time, right? And there's quite a possibility that what you basically do is you're hooking up to a company data feed of direct information that will come through from their enterprise resource planning systems, feed through to some generated on the fly report that you've created. That creates a whole lot of aggregation proprietary issues that are going on there, but it changes also the nature of reporting and insurance, so that then they have a lot more scope to provide the valuation based on that input data, and then you're delivering a potentially a lot more rawer data, and that's where the proprietary cost issue comes into play and how that evolves.
Yeah, but interestingly, that this is also become one question from our audience in Indonesia when we are going public about the disclosure initiative from the IFRS ISB. Their concern related to the how to choose the information that will not put their own company in danger related to the rivalry firms. So there should be some room from the company to choose which information, because they think that if we standardize the format of the disclosure, they afraid that all of the information should be go.
Yeah, and I think the lesson there is that you can over-regulate, and we shouldn't be trying to regulate everything to be a hard number.
It has to be balanced.
Yeah, we still want judgments there. We shouldn't regulate to be a hard number. We just need to consider when we're giving some choice and judgment that there's an investor learning curve that has to happen as they start to understand just how soft that number is and how that then feeds into their valuation models.
Yeah. And I think the use of the subjectivity also one of the factors that makes our profession become alive.
Yeah, absolutely.
Okay, Michael, the last question, I think, asking about the materiality of carbonization. So maybe Australia has more experience related to these items, to this issue.
Look, I think this issue of materiality is one of the reasons why we're seeing increased reporting about climate risk and what's going on there, why we see concerns about reporting about intangibles, because these items are so material to the value of the firm moving forward. Fundamentally, though, I think we have some bigger issues with understanding materiality as a concept. One of the other projects that I've been doing with a former honours student is actually looking at materiality, because what we find is auditors tend to use very much these sort of percentage-based heuristics and say, well, is the movement in that number more than X% of profit or X% of assets, then it's material. What we see from investors, though, is they're about trying to build a coherent story. And so as they build that story, it's not a quantitative, there's a large qualitative element about what is material. And while the practice statements that are out there say that we should consider both quantitative and qualitative elements, we see auditors who are essentially acting as a proxy for investors are making materiality decisions time and time again using these percentage-based heuristics rather than, and they're doing it on an account-by-account basis rather than understanding what is the materiality of this information in the context of the firm as the whole, in the context of the marketplace in which it's operating, which will lead to different decisions in both directions.
Okay, so you agree that we should look this materiality concept from the, well, from the users of financial statement?
I mean, exactly. I mean, if you look at the conceptual framework definition of materiality, it is about influence on investor decision making. It's just when auditors come along and compute it, they're looking at one at an account basis, and most investors, they'll use account-based information, but they're looking at valuing a firm as a whole, not an individual account. Materiality is an entity-wide concept, not an individual account concept from the way the investor thinks about it.
Yeah. Even from the auditors, they only can predict the level of the materiality from the perspective of the users.
And most auditors, and we were talking to audit partners about this, aren't thinking about this as materiality as they're a proxy for the investor in making that judgment. They've got their heuristics that have developed that are out their audit risk on the number, not about actually conceptually where they proxy for the investor in deciding whether this is material or not. And it's a big debate whether they can even do that task, given auditors often haven't played the role of an investor themselves. And so that's where we're trying to understand, can you get an auditor to actually think like an investor and how that influences their materiality decisions moving forward.
Yeah. Okay, so thank you very much for your comprehensive answers, Michael. And before I sum up everything about the lecture, I would like to give opportunity to all of the audience. Maybe there is any questions or maybe opinion, anything that you may share to our lecture. Just please do so.
So I've got a question in the chat. Is there any threshold for materiality as an auditor? The general heuristics they will use, if it's less than 5% of profits or assets, it's not material. If it's between 5 and 10, it's a judgment. If it's over 10, it's definitely material. But that's really problematic because you've got to understand it in the context of what's happening in the marketplace, because there'll be a lot of material changes that aren't material if you know the story of what's going on. So when we took some financials that we'd taken for real companies that we manipulated to see the materiality story, the investor judgments even on materiality change depending on whether you had industry knowledge or not, because the cyclical patterns that might happen in an industry, and if you didn't know those cyclical patterns, something looked material, whereas if you understood the cyclical patterns, it wasn't material. And so materiality is a lot more complex than any sort of percentage-based threshold that is what auditors are typically defaulting to using. And so we're really trying to move away from that, which requires more judgment. And I think we've got an education problem with the people outside the profession to get them to realize just how much judgment goes into accounting. And we're not about producing answers, we're about producing useful information for decision making.
Yeah, even the auditing standard does not regulate how the auditor should define the level of the materiality. So it all depends on the situations.
And look, some of these concepts that are not tightly defined, I think, are good. I was very pleased when we moved from reliability in the conceptual framework to faithful representation, because reliability has a connotation that you can actually measure it and quantify it. We do that in other settings. Faithful representation, everyone says, I'm not quite sure I know what that means or how I would even think about measuring that. And that's a good thing, because it means that you're exercising a lot of your brain power to say, am I making a good judgment here? You're being reflective and critical because you're so uncertain about what it actually means to be a faithful representation. Yeah, you can decompose it into the neutrality and everything, but it's not a clear-cut thing, and we want that degree of discomfort in making that judgment so that people will be paying much more attention, much more care in making that judgment rather than just applying a quantitative rule. Yeah. The materiality is the same.
I agree with that. So is there any other questions? Do we have other question in the chat room? No. So audience, if there is no questions, I would like to sum up this lecture, Michael, if you don't mind. So although we can feel relief, yeah, that based on graph presented by Michael, our product of financial statement is still useful. It is still relevant. And we are trusted as a source of information. So we should be so glad to hear all of this. But at the same time, there is also some questions about the reliability. The requirement to extend the scope of corporate reporting is so divine. So Michael has located some important areas that need to be improved and shown the response of stakeholders to several accounting standards that is quite the opposite of what we expected. Intangible asset, sustainability, risk, and forward-looking information are among the most weighted areas to be revolutionized, and investor needs them urgently to help them in decision making. So there is no time for us to delay or even maybe pretending that our product, which is financial statement, is still in the top of use. Being on top maybe still true, but becoming extinct is also possible. So as academician, it requires our determination to produce more insight through our research, through the projects like Michael, for example, to be contributed to the regulators, companies, and other related parties to formulate better rules, better standards, better operation procedures for the betterment of society. So I think this is the end of our lectures. As a moderator, I thank Professor Michael Davern for the insightful lecture, and for all of the audience for your participation. And I personally apologize for any inconvenience that you may have during the event. And I pass the Zoom back to our Master of Ceremony, Mbak Merinda Tasya. Thank you very much, and bye-bye. See you again, Michael.
Terima kasih. Jumpa lagi.
Sama-sama.
Okay, thank you, Prof. Michael Davern and Dr. Devi for the very insightful and also informative session about financial reporting and beyond. For all the participants, we'll inform you to fill in feedback question and fill the attendance sent by committee via chat rooms. And before we close the end of session, please everyone open your camera so we can take the photo. And maybe the committee, can you help me to take a photo? Okay, start from page 1, 3, 2, 1. Okay, next page. 3, 2, 1. Okay, I think that's all. Thank you very much. Once again, thanks for Prof. Michael. We appreciate you being here, and also thank you for the everyone to attend the guest lecture 5. And for the next guest lecture, maybe the committee can help for share screen, because we have an interesting topic too, corporate social responsibility, committee international evidence on 31st of May 2022 at 9 a.m.
You've got a very interesting series.
It's no, Prof.
Yep. Thank you very much for the opportunity to present. I'd be happy to come again and do some presentations on some data analytics related stuff if you're interested in that as a topic area as well.
Yes, Prof.
All right. Thanks very much. Please stay in touch.
you.
All right. Bye-bye.
Thanks, everybody. All the best.
Okay, thank you, bro.
Bye-bye.
Bye.
Thank you.
Okay, I think that's all. Thank you very much.